Hello everyone. Thank you for stopping by the channel and watching this video. Welcome to WTF Mortgage. As the title and thumbnail might convey, I'm going to cover 5 realistic ways to pay your mortgage off faster and save interest for those of you who are interested in paying your mortgage off faster, because that is not for everyone. Now, this video was inspired by a comment that I received a couple months ago from a Matthew Boone 8406. And Matthew Boone 8406, if you catch this video, I apologize. I actually took 4.5, 5 months off to take care of personal matters. I returned a couple weeks ago, but then had to play catch up. So here I am. Of course, I normally don't do that. I normally respond promptly. So again, I apologize. So Matthew writes, if you dump, well, there's a couple of typos there. I'm sure he meant if you dump. So if you dump all your income into extra principal payments, where is your liquidity? So Matthew is responding to the third video that I made on how using a home equity line of credit to pay your first mortgage off faster does not work. And the proponents of this idea of using a HELOC to pay your first mortgage off assert or encourage folks to get the home equity line of credit and then put all of your income that you make into the home equity line of credit, then take the home equity line of credit, use that to pay your mortgage and all of your other bills. And when you need money, tap into the home equity line of credit to get those funds. And of course, I advocate if you are looking to save interest, pay your mortgage off faster, make extra payments. Of course, I also let people know, get your interest rate as low as possible, but making extra payment has a much more profound effect on paying your mortgage off faster and saving a ton of interest, just making extra payments. All right, here we go. Scenario number 1 in paying your mortgage off faster and saving a ton of interest. So this scenario is based on a 30-year term, 6.5% interest rate, a $350,000 loan amount with a principal and interest payment of $22,1224. And of course, principal and interest, that's the loan payment. That's just the loan payment without the taxes and insurance. So BiWeekly is essentially splitting your payment up in half and then making that half payment every 2 weeks. Making your payment a half payment every 2 weeks results in 1 extra payment per year. So here we go. So you took that, we took the 22,1224 and split in half. That's 110612 every 2 weeks, as you see right here. What that does is cut 6 years off the loan, 6 years, and results in $102,808.74 in interest saved, which of course, that's a massive amount of money. And so this scenario was based on someone that had an income of approximately $71,000 per year. And after paying the principal, interest, taxes, homeowner association dues, any additional insurance, and their bills, they have $960 left over per month, which is your residual income, the income you have left over after all the bills. Now, out of that $960, this disciplined person with a game plan in place would put $235 into savings. Then they put another $200, leave that in their checking account for expenses and additional bills that might come along or whatever they need it for. And then another $200 in investments, thinking about the future. Now, they also do have a home equity line of credit that they got, a $25,000 home equity line of credit. But it's just there, zero balance. You're not paying any, they're not paying any interest on it. And it's not necessarily there in case for emergencies. It's there for opportunities. This person knows that she can't rely on a home equity line of credit only like for emergencies, because that's never guaranteed. At any time, the bank can pull that home equity line of credit. It was done to me personally back in 2008 and 9 during that craziness that we had. But of course, I wasn't relying on that for an income source. So it didn't really do anything. It didn't do anything to me. I just couldn't use the line of credit anymore. So I ended up just paying it off. And it also happened during the first uncertain parts of COVID. Lenders stopped doing. Many banks stopped doing lines of credit and even froze some of them. So this person uses this for opportunities that might come along. Or whatever, but they're not relying on it as a primary source of liquidity. As you can see, putting a substantial amount of money based on the residual income, putting a substantial amount of money into some very productive places. All right, so that's a bi-weekly scenario number one. Let's go to scenario number two. So scenario number two, same thing. It's still a 30-year term, 6.5 rate, $350,000 loan amount, 22, 12, 24 principal and interest payment. But this time, instead of setting up a bi-weekly pay plan through the lender or bank to whoever the servicer is, they just arranged making an extra payment monthly. This is the way I first did it. I just set it up from my bank account, my bank app, to send a little bit extra every month. And that's how I actually personally did mine. So this way works for someone who doesn't want to do bi-weekly, because one thing, I've been doing this for now 26 years. February 13th was 26 years straight mortgage, no breaks in between doing this. And one of the things I learned at the first two companies I worked at that did biweekly payments, they made sure that we told the customer that biweekly payments increases your chance of default. It does, especially if you're not accustomed to doing that, because on biweekly, you're actually set up on a program. So it's not like a choice where, you can pay whatever you want to in the middle of the month, and then as long as you pay the rest of the mortgage by the end of the month. No, if that, $1,100 payment is due at 1 week, and then the other 1,100 is due at the other week, you need to pay that, or you could get a late payment fee, late payment penalty. So many people, instead of biweekly, and the forced into making a biweekly, prefer, like I did, prefer just contributing extra monthly. So in this scenario, this person is making $250 a month. Now notice how it's the same scenario. The person making $71,000 per year gross, and they have $950 left over after all mortgage payments and the bills. So they're making $250 extra monthly. This cuts 8 years off the loan and saves $126,604.17. And so with that residual income, what they're doing is 250 of that is going towards that extra payment. As you can see, $300 this person is putting into savings, $200 stays in checking, $200 in investments, and they're doing the same thing. They have that HELOC just on the side for opportunities or whatever. They're not relying on that as their total source of income. By the way, I too, right now, personally, true story, I have a HELOC right now. I usually keep one, and I have zero balance on it. And that's what many of the successful real estate investors, that have, 20, 40 properties that I had the pleasure of working with and doing loans for do. They have 1 or 2 lines of credit, zero balance. When they do run a balance on it, they have a plan when they're flipping a property to take care of that really quick. They don't leave money on that line for very long. So here's another person that is liquid, and if they need it, and they also have a $25,000 HELOC they could tap into, $25,000 with no balance, so they're not paying any interest on it. So let's go to scenario number 3. All right, so in scenario number 3, this person is making an extra payment each year. And I've seen that done successfully before also. It comes out the same way. So some people get like a regular yearly bonus from their job. They take that yearly bonus and dump it into the mortgage. And again, this is for people who are looking to do something like pay their mortgage off faster. Paying their mortgage off is not something everybody wants or needs to do. I've seen some people do it with their income tax return. Take that, dump it into the mortgage. So this person is taking their yearly bonus plus a little extra money they have, and once a year making a $3,500 extra payment. Making this $3,500 extra payment cuts 9 years off the loan and saves $140,498.13 in interest. And notice how it's the same person, income earner, $71,950 left over. So $550 goes into savings, $200 stays in checking, $200 goes towards investments, and yes, they've got that HELOC again. So this person is very liquid. They have a HELOC that they're not paying interest on that's available if they need to tap it. All right. So let's go ahead and go on to scenario number 4. Now, scenario number 4 involves a couple, and this couple has one person making $55,000 a year and the second income earner making $60,000 a year. All right, so this person, this couple has a goal to pay the home off before they retire because they don't want to have that mortgage payment when they retire. So talking to their mortgage loan originator, they discovered that the payment was a little bit too high. They didn't want to go that hard into it. So the mortgage loan originator gave them the option of said, hey, what do you think about a 15-year payment? And then they looked at it. It was cheaper than the 13-year payment. And they're like, okay, we'll go with that. We'll just have maybe 2 years or less left from when we retire, but we'll have enough money saved up for anything that we need, and we can take care of that in maybe another year and a half or so. So switching from this 30-year payment to making a 15-year payment. Now notice how I said they didn't refinance it to a 15-year loan. They didn't do that because they don't want to get committed to a 15-year payment, but they're going to make a 15-year payment on their own, which is a great technique to use. You make whatever payment you want to, 10-year, 15-year, 20-year payment on your own instead of getting locked into a particular loan. And switching from that 30-year loan to making a 15-year payment saves $282,980 in interest. It's massive. So after they pay principal, interest, taxes, and insurance and all their bills, they have $3,500 monthly residual income left over. They take $1,056 of that is going towards making that 15-year payment, making the extra money on top of this 25, 28, 27, because, I forgot to mention the scenario on this one. It's a 30-year term, 6.5 rate, $400,000 loan amount. So that's a principal and interest payment of 25, 28, 27. So in order to make it a 15-year payment, they add an additional $1,056 to get this 8343 15-year payment. So out of their $3,500 residual income comes the $1,056 for the extra payment. $1,000 goes into savings. $500 a month stays in checking. $500 a month goes into an emergency fund, and $444 goes into investments. And looky here, they've got a $40,000 HELOC that they haven't tapped into, so they're not paying any interest on it, and they have that again for opportunity costs or whatever, and they're highly liquid. All right, so now let's finish off with our final scenario number 5. All right, so our final scenario involves that same couple with a dual household income again. And so this time they thought about it after they set up the 15-year payments. After talking with their loan originator, they decided, we really do want to pay this off in 13 years. We really don't want to have this mortgage payment over our head, so to speak, when we retire. So the mortgage loan originator suggested, how about continue making the 15-year payment, but go on a biweekly plan. So they're combining both the large additional extra monthly payment to make it a 15-year, and they're going bi-weekly. So by going bi-weekly, they cut an additional 2 years off the loan. So that takes them down to their original plan of going 13 years. And the interest saved $370,583 massive. And then same thing out of that monthly residual income, 1,056 goes towards the extra payment. Now, biweekly does result in higher extra payments because over the course of the year you're making actually making one extra payment by paying on 26 pay periods. So that results in effectively an extra $290 a month. So out of the $3,500 residual income, 1,056 to make it a 15-year payment, $290 for the biweekly, $710 going to savings, $500 in checking, $500 emergency fund, $444 in investments, and they still have that $40,000 HELOC that they can tap into, but there's zero balance, so they're not paying any interest on it. So as you can see in all these scenarios, they shaved quite a few years off the mortgage and saved a ton of interest. So you can make extra payments and be highly liquid and not be relying on a home equity line of credit that could be here today and gone tomorrow. Plus it's a debt, actually, a debt that you can manage to achieve something with it, but it's still a debt, a liability. All right. And in closing, I'd like to show one more thing. This right here, this is what it looks like to pay a 30-year loan with a 6.5% interest rate and a $400,000 loan amount off in 30 years, 25, 28, 27 a month. Of course, like I showed you in the previous scenarios, because these are the same numbers I used for the last two scenarios, you pay a ton in interest taking the 30 years. But this is what it looks like to pay it off in 5 years. There's no tricks or anything with this. You can calculate this in any mortgage calculator yourself. Look at what this 5-year payment is. Instead of 25, 28, 27, $7,826.46. Look at that. That's the real deal there. That's how a 5-year payment looks on a $400,000 loan. Now look at this one. Here's a 7-year payment, $5,939.77. So without even watching any of my videos that I did on how using a home equity line of credit to pay off a first mortgage faster doesn't work, and the concrete proof that I've provided, especially on the third video when I put a ton, like, I don't know, 24, 27 or so third-party links that you can verify what I'm saying is true. And look at this. Without even watching that, you can just use some common sense and say, okay, seriously, just using a home equity line of credit to pay that, you're really going to pay that much extra per month? Hell no. This is right here. I notice on any of those dream videos where they say, hey, pay your mortgage off to 5 and 7 years, not one of them has showed what the payment, a 5 and 7 year payment, really looks like. This is the reality of it right here. Okay. So I will leave you with that and sign off. I hope this video was informative and you enjoyed, and I will see you on the next one.